Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. I'd like to welcome you to tonight's event, The Use of Artificial Intelligence in Financial Risk Management. Please note that the opinions expressed tonight are those of the panelists and do not necessarily represent their organizations. And now I'd like to introduce tonight's moderator, Naveen Sharma.
Thank you, Jay. Hello, everyone. Welcome to the AI risk management discussion. We hope we have a good discussion and Q&A the second half of this event. So hopefully you'll join us. We'll have engaging conversation. So AI in risk management is a very timely, fascinating topic. And we thought that it would tackle it because it is so nascent and we're all trying to get our arms around this. I used machine learning, which is a AI technique, about 5 years ago. I was doing some bond analysis work, and I found it to be much more useful, more accurate than some of the standard quantitative techniques I've been using for a long time. But today you have such a wide variety of AI in function and use. You have agentic workflows, right? You have NLP, you have what do you have? Neural networks, deep learning, and so forth and so on. So it creates a lot of complexities, and so consequently, we have concerns. And so those concerns we'll try to tackle and discuss some of these issues. Obviously, it's a vast subject. We're not going to be able to cover much of it. We'll do what we can in the time that we have. And hopefully with your questions, we can have a meaningful discussion. So one of the more recent issues that arose, do people aware of the Anne Hathaway effect? So actually, this is fairly recent. I mean, from what I've read, and by the way, I don't think this was an hallucination, is that even this year, this occurred where sentiment analysis and some trading algorithms would notice the word Hathaway, and it would see some positive sentiment beyond it, and it would go and buy thousands of shares of Berkshire Hathaway stock. And it turned out it was really a very nice article about Anne Hathaway in the Oscars or something like that. So perhaps we're past all that. So we'll see where that takes us. Some of the issues that I wanted to just talk about risk-wise that we have to all think about and deal with. Three of the big ones I think about is AI herding. So this is where, all investment firms, banks use the same foundational AI models, as we know who those are, and they come from the same vendors. And then it's possible that the response and the results they get under very certain conditions might be the same. And so what if there's a significant market volatility event? And what if these models begin to say sell? Right? You could have a flash crash, right? You could have perhaps a liquidity crisis come out of that. So that's one of the areas worth thinking about. Another one is the black box model, which I think we're all familiar with, which would be if we have deep learning. If the deep learning may not potentially give you, explain to you why the result is what it is. That could also violate explainability mandate when risk managers talk to investment committees and so forth. And regulators are well aware of this, and they're taking steps to be more actively managing and monitoring these areas. And then, of course, we know about hallucinations. And what about model drift? This is where a model is trained on not the most up-to-date data. And supposing a regime suddenly changes, the AI model may not catch it. And consequently, you could have an issue, a problem arise with your investments. So these are some of just a few of the items and topics that it's worth mentioning and to think about. And we'll go into those in more detail. I will say this, though. I think, with all this sea change that we have, I do think there's one constant. And I think this constant is the fact that the deciding factor remains the experience and judgment of the risk manager or the risk executive that's overseeing this. Because AI is too complex and too opaque today to be left alone. So with that preamble, what I'd like to do is to turn it over to our panelists. They will introduce themselves, opening statement, then we'll go into some questions and answers. So, Sushant, so kind.
Thanks, Naveen. My name is Sushant. I had fixed income risk at Morgan Stanley Investment Management. I actually started my career in trading and prop trading while I was in India. After a few years, I realized I wanted to study things deeply. Came to Carnegie Mellon, studied computational finance there. And instantly, Naveen was my first boss in the US, and learned under him the intricacies of fixed income risk. Went away for a while to work at a hedge fund where I was working on portfolio optimization and construction, but then came back to fixed income risk 6 years ago. Been with Morgan Stanley since then, and currently overseeing the fixed income active business, which is around 220 billion or so. So oversee risk for most of that business currently. Excited about the potential of using AI in our daily workflows. And I remember back when I used to work for Naveen, and the prevailing wisdom back in the day was financial data is very noisy, and AI, machine learning is all good and dandy, but with the kind of noise we experience in financial data, it's probably best to stick with simpler models like regression. The signal to noise ratio just does not, merit models of that level of complexity. There's a big risk that you'll be fitting to the noise. And for a long time, that was true. And it was true in the sense that when you're working with financial data where indeed noise is large, signal is low, you want to stay sparse. But I think what we have realized now with the advent of AI and Gen AI in particular is that we were in some ways asking the wrong question. Or at least that was a limited view of things. If you think about financial data, yes, it is true that noise is large, simpler models are better and all that. But a bigger question could have been raised around where in the world can we use these more complex models, the deep learning models, the neural nets, and can the question shift from just analyzing financial data to solving financial problems, even if that means using different kinds of data? And in a way, we are now ready for it because something that happened prior to the AI wave was the alternative data wave. And when you start working with alternative data, suddenly now you have utility for all these more complex models. And some of that we are realizing now. Some of that is still largely, in the realm of imagination so far and hyperbole, but there are low-hanging fruits that we've found that are currently useful, and hopefully we'll get to touch on that in the rest of the segment.
All right. Jakob Schenkman, head of US fundamental equity risk at BlackRock. So my career is somewhat similar, but I've been at risk for the entirety of my career, close to 20 years. Started out at Morgan Stanley Investment Management, actually, about 20 years ago, covering equities. Then moved on to covering fixed income on sell side. So at Morgan Stanley Investment Bank, securitized products, but then pivoted essentially back to equities. I've been at BlackRock for 13 years, close to 13 years. And at BlackRock, I cover US fundamental equity business, which is essentially your mostly long-only equity, concentrated equity strategies, roughly $150 billion in assets under management that invest globally across the world, different strategies, different styles, but primarily long-only, some hedge fund strategies. So I've been primarily an equities expert for the entirety of my career, covering equity markets across the globe. When it comes to AI, I think, again, taking a slightly different kind of spin to it, it really comes down to scale. And I think it's important to understand what is the risk manager's job, right? What is the task at hand? And in a lot of places, it's very similar. you have oftentimes hundreds of portfolios that invest according to different client mandates, face different constraints, and you have a fairly small teams of risk managers making sure that the firms fulfill their fiduciary responsibility when it comes to overseeing those strategies, making sure those strategies adhere to client constraints, that none of the regulatory requirements are violated. And increasingly, you have to do that against the backdrop of markets that are changing rapidly, right? So as volatility goes up, you have kind of rapid risk on, risk off types of events. So how can you do it at a quality that clients expect from you, but with a speed that requires you to be nimble, to do more things with maybe sometimes similar level of resources? And this is kind of where AI comes into play as kind of force multiplier. Now, notice I didn't say have AI do something instead of a risk manager, but it's really how can we augment risk managers who are subject matter experts in equities or fixed income, but do things that they're required to do at scale that the businesses require, right? And kind of while still adhering to the standard of oversight that's required. And I think this is where AI first and foremost comes into play today, when it comes to being able to scan portfolios, hundreds of portfolios quickly, understand anomalies, right? Highlight anomalies that, quite frankly, is impossible to highlight by looking at one portfolio at a time. And then, when it comes to markets, how can you react and come up with, stress test your portfolios to reflect most recent, most interesting market developments? And again, having to do that in days, sometimes hours, possible, but very hard to do when it's just a team of 4 people. But AI, again, can help you do that in a way that allows you to do things quicker and better, again, with kind of oversight from subject matter experts. And I'm sure we'll talk about that and kind of how that will evolve going forward.
Hi, my name is Cindy Williams. I am the U.S. Head of Risk Governance and Policy at Scotiabank here in New York. So what does that mean? So the risk governance piece is I corral everybody dealing with the enterprise risk management framework and also the risk appetite statement, making sure that we have consistency globally and also understand how we may have a different need here in the U.S. and make sure that it's fit for purpose. The second part of that is dealing with the policy governance in the U.S. And so I'll spend a lot of time. You'll hear a slightly different perspective from me today, more from the business owner side. For the policy management, we have a different need than some other areas of the firm. I would say that we're much more highly regulated here in the U.S., so there's a higher touch. That may change since the Fed just came out with a statement a couple of weeks ago, noting that they will be changing their strategy going forward. But that being said, we still want to do what's right for us, which is to continue to move forward and become efficient and effective. So with that, some of the things that I'll be talking about today is policy governance and how we're looking to add AI to our policy governance. As you can imagine, a lot of people probably think that writing policies and procedures is not their day job. So we want to make sure that we have as many tools and opportunities to help people craft policies to make sure that they are being followed, that they're effective, that they can be implemented as written. Because policies and procedures really are a codification of the corporate culture at firms. So they really are important. And quite often people may think about, let's get this new tool out or this new process or new training or what have you. Having those documents and having that corporate culture written down really helps permeate how the firm wants to act in a respectful way. So some of the things I'll be talking about is how can we use AI to develop policies? How can we look at doing gap analyses? How can we compare the information that we want to have in a policy or procedure to documents and information that the firm already has someplace else? Some of the things that I'm also interested in talking about is having an audit API. And so what I mean by that is we really want to have specification and details on the logged fields, like timestamps, agent and model versions that are used, input features, the context, the immediate thoughts, the outputs, and immutability requirements. So being a former regulator, I very much interested in always having an audit trail. I want to make sure that whatever decision that we made, that it's documented, that we understand the nodes or the decisions that were made and what the final outcome was. And it's also very helpful because sometimes you don't remember. So when you get to a certain age, you might have CRS, can't remember stuff. So it's very good to have that documentation. So those are some of the things that I wanted to talk about today. I'm very interested in hearing your conversations and questions too.
Thank you. So you notice we have fixed income, equities, operational risk of all the investments covered here. So complete circle. Just to close the loop from my side, I'm a head of risk and portfolio management partnerships at Fitch Solutions. I was recently chief risk officer, proud of that, at HIMCO at the Hartford. I've been in a leadership position at BlackRock, where the three of us work together and have been in the risk management side for a number of years. And having seen the evolution of risk, I think this is another significant step in the risk management profession of thinking about AI. So I'm very glad we're able to talk about this today. We'll start with some questions. I'll go through the panelists, and then eventually, like as I mentioned, in about 20 minutes or so, we'll take some questions from the audience if you have any. So Sushant, we'll start with Sushant. Let me ask you this. So where's AI actually adding measurable value in risk management today versus where it's still just speculation?
Okay, I think there are areas where we're already seeing a lot of uptick in the use of AI. But before that, let me say, financial industry has always used a lot of ML techniques, and in fact was the harbinger of many of them that we don't today consider AI, or when somebody says AI, we think of Gen AI, we think of LLMs. We don't typically think of the traditional machine learning algorithms that were always there, and they were used for example, if you segment risk management into risk modeling and risk monitoring, then in the risk modeling section, you have factor models, you have regime models, all of which freely draw upon ideas from ML, whether it is supervised learning or unsupervised learning to identify clusters, identify risk factors. And on the other side, in risk monitoring, you have anomaly detection, and a bunch of machine learning methods were already being used there to try and find anomalous data before it becomes an issue. But today, when we say Gen AI or LLMs, the low-hanging fruit is summarization. And you can imagine creating 300 pages of risk reports and sending it to your CRO. One, it won't be useful. And secondly, chances are slim that somebody will go over each and every page and then decipher a lot of value out of it. On the other hand, what LLMs are really good at is, reading voraciously and distilling that into a, shorter summary of the most salient points, the most insightful turns. And that's probably much more useful for people in senior management, senior risk management. The other one I want to say is, as risk managers, we all always worry about what's not in the risk model. Because what's in the risk model, you're probably going to be fine in terms of your ability to oversee all of that. The trouble with the risk models that have dominated financial landscape for the last few decades has been their extreme reliance on just market data and some reference data. In fixed income, that would be rates, spreads, FX movements. That's all the market data. And then reference data would be what sector, industry, or coupon or what have you of the security. And it tries to map the risks of those securities onto these very limited number of market and reference variables. What LLMs allow us to do is think of, if you had an intern who could read 5,000 pages a day, what would you have him do? The intern probably doesn't have the wealth of experience of many years that you do, but that intern, and I'm talking about the LLM, can read voraciously, can read 5,000 pages, come back to you. It can read all the 10K documents of every company. It can read every new financial regulation that's coming out, and it can keep a tab on all the news items affecting anything and everything, and then map it back to your portfolios, what you hold in your portfolios. And you can ask it, there was a new, let's say, a draft regulation from SEC. It mentioned emissions a lot, or certain kinds of emissions a lot. Do we have any vulnerability in our portfolio? And then it can go take the next step, run through the list of your portfolio holdings, look at their 10K documents, see if there are any exposure to those sorts of emissions, and come back with, okay, these are your vulnerabilities. So this is the sort of thing that none of this is rocket science, but just by the sheer horsepower that LLM brings to this exercise, you're able to do a lot more than you were able to do before.
So Jakob, I guess taking from Sushant's comment, what are some of the long-term and short-term benefits you're finding at your firm or in the industry?
Sure. So I think taking it further from what Sushant talked about, so kind of marrying the tools as is with data that's available internally allows you to do a lot of other things. Training the models or customizing the models to the context of your portfolios, your methodologies of how you do things, how you calculate risk, how you identify risk drivers, behavior your portfolios allows you to get a lot more leverage out of those tools. And then you I'm sure we'll talk about kind of you overlay agentic approach to that data. In other words, specific agents trained on specific tasks that are allowed to kind of reference specific either documents or data or tools where you know what's going in and you kind of have a better understanding what might come out from that particular agent. I think allows 10x the value that you get from the standard models. And one example, just kind of practical example that I want to talk about is stress testing. As I mentioned, markets evolve quite rapidly. So at BlackRock, we have a pretty standard way of coming up with kind of market-driven scenarios. It's, let's take tariffs as an example. You know the tariffs are upcoming. You're trying to understand the drivers, the historic backdrop, how the particular event might play out. Then you try to understand, well, is there any historic precedent to the particular event that you can use to either size the shocks or figure out the key drivers, market drivers. And then you have to figure out, well, what are the shocks you want to apply to your portfolios and size those shocks. So kind of in good old days, it would take up to a month to come up with a draft scenario, then work with experts within the firm to either macro experts, equity experts, fixed income experts, and to understand whether the kind of the draft scenario makes sense from a macroeconomic perspective. It's not violating any sort of kind of relationships that are kind of hardwired into the markets. And then you sort of release the scenario, you apply it to portfolios. But what if you have to do it in a matter of days because you have an event on the horizon? Well, you've been successful in training models on methodology of how the stress tests are constructed, but then allowing the tools tell us either whether there are any historic precedents to an event, kind of draw parallels, and to, maybe identify similarities, but also differences from how things kind of played out in the past. Suggest potential variables that might be useful and shocking, that are kind of can distill a particular event to key drivers that can be applied to portfolios, and also help draft a narrative, right? Again, at the end of the day, this has to be kind of presented to the boards, the portfolio managers. You can't just have the numbers. You need to have the narrative, why you've picked a certain way of kind of constructing the scenarios. Either is there historic precedent? If not, why today's environment is better representation of what you're trying to model. So again, using the tools that we have at disposal, trained on the methodologies that are kind of been developed proprietarily in a proprietary fashion, allows us to do things much faster. Are they perfect? No. Again, I'm sure we'll talk about having experts still in the loop, making sure that the output makes sense, that it's coherent, that it's in line with sort of latest thinking about the markets, the portfolios, but pairing that with the speed that the tools allow us to develop things, again, makes us much more effective, quick to sort of deliver analysis, and then of course have the discussions and follow up analysis.
So the talk about building models to building policies. So Cindy, what are your thoughts on that?
So right now, you can already get in the industry policies that have been written. So you can have something to start with. Often the generic policies are written for smaller firms, but they do look at regulation, any industry best practices that might be available, and so on. But if you're able to use AI to draft policies, you can actually go a lot farther instead of starting with something that's pretty generic and for maybe a different size firm. So if you use AI to draft a policy, you can look at, once again, the regulations that are out there. You can also then compare it to everything that you have internally, other documents, policy documents, be that policies, frameworks, procedures, standards, what have you, that you've already written. So it helps customize instead of starting out with something that is generic. Also, you can do a gap analysis. So if you have, say, your SR 11.7 model governance, there's an update to that, and you want to know what that is. You can have some sort of dynamic updates, but you can also be looking at what kind of gaps there are. It would compare that document. You could look at a group of them at a time. So you have a hierarchy of documents where you have what goes to the board, which would be like a board level policy, the regular policy, a procedure, possibly guidelines, and making sure that all of those, they overlap what they need to. And if there are gaps, then you can use AI to see where the gaps are. We already are doing that to some extent, and we're looking to enhance those capabilities. And then dynamic updates. As I noted, like I say, SR 11.7, there are some updates to that on maybe the definition of a model, since we've been talking about models so much. And then you would have some sort of regulatory horizon scanning where AI is looking to see what is the net new documents that are out there, or regulations, and then seeing what policies that you have, going to the various paragraphs that talk about models, and then note those documents that may need to be updated and where, and then have an email sent to the owner of the document, the policy document owner, so that they can then look to make those updates. So that's some of the things that we're looking at, which would get past starting off with that generic document that you can purchase off the shelf at this time, to having something that's much more customizable and that's also dynamic.
Cindy, how do they decide how frequent to do the updates?
So right now, we look to, at least for our policies and procedures, we look to update continuously. So even if it's a large change, definitely make sure those updates are in there. But even if it's something small, like there is a new name of a department, we're looking to always have those updates. And if you're talking about the updates that would happen with the horizon scanning, some firms do it weekly, some of them do it daily. It just depends on how often you want those type of emails also to be going to document owners. So some of the things that we found out are there's certain times a day that it's better to send those those email notifications out. So you don't want to send it out on the Friday after Thanksgiving. So you just need to make sure that when you do those updates, that whatever kind of communication the document owners are going to get, it's going to be a time period where they're really going to have the capacity to respond.
Okay. Let's move on to Sushant. So let's switch from building to data. And so, Sushant, what are your thoughts on data modeling and AI, and how does that fit together?
I mean, AI has opened up, on one hand, the kinds of data that we can use, that we can consume. So for example, if you look at pre-AI or pre-Gen AI, we mostly relied on market data. Like I said, anything that you can think about the securities, their prices, their other characteristics, their sectors and industries and so on, and use that to try to create a map from those characteristics to the risks of those securities and the risks of the portfolios that held those securities. What AI has enabled now is that we can actually consume all sorts of data, a lot of textual data, but also multimodal data, and sort of transform all of that textual, noisy, unstructured data into perhaps quantitative signals that then the models of the past can consume and use. So yes, on the one hand, AI has made that possible, but on the other hand, I'll also want to point out that the data pipelines themselves have to be upgraded. When you think about what's actually happening in industry is, a lot of upgradation of those data pipelines has to happen for really taking advantage of the capabilities that the new Gen AI models have made available to us. And so there is gains to be made, but there is also work to be done, not just on the models themselves. Actually, there's less work to be done on the models themselves, but more work to be done on the data pipelines that will make these models useful and be able to take advantage of their capabilities. I can give you a couple of examples where in the past we would have not thought of it, or for want of resources to put in all that effort, it would have been a no-go from the beginning. But think of supply chain data. As risk managers, we are always thinking about our exposures to various things, and we're trying to reveal tail risks or trying to reveal our concentrations in one part of the portfolio or another. And a simple approach would be, okay, look at your portfolio holdings. You have so and so exposure to a certain industry and so exposure to a certain country, and those are your vulnerabilities. But AI allows you to do this multi-step thinking where, for example, you might have a lot of companies that all have, and again, data becomes a big part of it, because with supply chain data, you'll be able to see that you have N companies, all of which have this vendor or somewhere in their supply chain, they're all dependent on this eighth company. And while you may not have exposure to that company directly, because of the availability of supply chain / alternative data and the ability of these models to consume and process that data, you can now see that you have a vulnerability to that particular company going south.
It sounds like is a real opportunity to extend counterparty risk
Yeah.
analysis, for example, again here.
Yeah, so some of those kinds of things are now possible.
Yaakov, what additional risks do you see with AI?
Risks.
Yes.
Okay, so
We're in risk management.
this is a risk management panel after all. Look, I think Cindy mentioned it, but I'll kind of expand on it. Interpretability is very important. I think I can speak for all of us. A lot of kind of activities that we conduct on behalf of our clients and firms are required by various regulations. They have to be auditable. There should be a trail of kind of what's been done, what was been looked at, how the decision has been made. So it's quite hard to just allow the machine to make those determinations without being able to point to the data sources that were used to make that decision, and also quote unquote the algorithm that's been kind of used to arrive at the outcome. So I think being able to interpret the data and kind of link to the underlying kind of assumptions, modeling assumptions is very important. And there are ways to do it. They're still being developed. Again, kind of if we talk about agentic AI, kind of controlling what basically, first of all, limiting the activities and essentially simplifying the workflows of each agent so it only focuses on modeling or, I don't know, reading podcasts and transcribing 10Ks, right? It allows you to, at that kind of agent level, to understand exactly what's going in, kind of what decision trees kind of is being applied to come up with the outcomes. Maybe it's the summary or maybe some kind of suggestion in terms of a particular company or particular risk metric. I think that's one way to do it. Of course, applying sort of all the standard model risk policies that are applied to ML and other standard models to AI, and kind of testing sensitivity of AI to inputs, sensitivity to prompts, sensitivity to kind of errors in the data or lack of data, all the things that are kind of happening, and kind of the policies that are being written and developed and continuously updated. So those are the things that kind of obviously makes us pause, and that's why I don't think, well, again, speaking for what I do, also things that I've done on the kind of investment side for business that I cover, none of the AI tools, LLMs or whatnot, are not kind of left to their own device in terms of making decisions or trading decisions, right? There's always subject matter in the loop, reviewing the outputs, making subjective call whether it makes sense, right? Going back and essentially kind of some cases interrogating the process of the analysis. The day might come where the models are trading on their own without any oversight, a little oversight, but at least for kind of regular activities that we often deal with, we're not there yet for the reasons I just mentioned.
Cindy, in terms of risks on the policy side, how do you deal with things such as redundant language, contradictory clauses, and just consolidation of policies?
Yeah, so the one of the things I think AI is really going to help quite a bit, and we're just starting out with this, is looking for contradictory language. So if you have 3 documents, we'll call them procedures, and one of them has that this group can take a car service at home at 8 p.m. at night, one has 9 p.m., one has 10 p.m. There may be a reason why those are different. It could be that the traders, they get in much earlier in the day, so they should be able to take a car service home earlier in the evening. And then we also have things that would work. Maybe one policy permits remote access, where another one would restrict it. So the remote work policy should be updated to see if there are contradictions and if they're appropriate. The same thing with if you're taking a car service home at a different time period. And then for looking for redundancies and consolidation. So this is something that I get a lot of feedback on. People are like, well, we have 5 documents, policies, procedures, and 80% of them say the same thing. Do we really need to have 5 documents that pretty much say the same thing? And so this is an opportunity to, because as the human in the loop, we've talked about there should be a human in the loop through all of this. It may be difficult for you to be able to go through that many documents to see where there are redundancies and opportunities to consolidate documents. It's much easier, instead of having to read 5 or 6 documents, having to read 1 or 2. And then having it and not having to go cross back and forth on trying to find where there might even be differences and where they're the same. One of the other things that we're also looking to do is have semantic consistency. So if there are terms that are used, if we say that this is how a client is defined, there may be reasons why it's different in certain locations, but you want to have clients defined the same way throughout all of the documents. And also the tone, we want to make sure the tone is appropriate. So for something that is mandatory, we want to say things like you must do something. The tone for a guideline would be different, where that would be recommendation or such. So you want to make sure that there is that the tone is also appropriate, because often I find documents, they'll say the tone will change throughout. So those are some of the things that we're looking to make sure, it's contradictions. Sometimes it's okay to have them, but you need to make sure that you understand that when it is okay, and then understand when it's not. And then the redundancies, people don't want to read 20 documents when they could read 2. So that really helps becoming much more efficient. And then just having that same tone also helps with the corporate culture, because it makes sure that people are speaking the same language.
Thank you. All right. All right. It looks like we have 20 minutes left, and having solved the AI and risk conundrum mostly here in 40 minutes. Let's talk about the future. So Shant, thinking out, 5 years, say, what do you think is going to be the impact of AI in terms of risk management?
I think the role of the risk manager will change quite a bit in 5 years. And I completely agree with Yakov's point earlier that, in risk management, where auditability, explainability, interpretability are big themes, you'll always need a human in the loop. But the role of that human might look very different from how risk management teams function today. If I think about my time here as well as earlier in different firms, many of the risk management professionals, a lot of the time, they are collecting data, generating reports, and I would imagine that while it might be 40% of your time today, will go down to less than 5 to 10% of your time in the future. And the big task of the risk manager would be to work with the AIs as AIs get better and better. And the better questions you can ask the AIs, the more effective you're going to be. And I see this role as a bit of like the master and his emissary, where you cannot trust the AI to be a big black box that outputs answers, but what it can serve as is some sort of an early warning system where it alerts you to certain things, but it is your judgment as a risk manager to thoroughly vet those things. And again, that opens a new can of worms. How much time should a risk manager be spending just verifying things coming out of an AI? And hopefully AIs will get better as time passes. So that'll be a smaller portion of your time, because it can make a lot of type 1 errors. It can keep alerting you all the time for non-issues, and you don't want to be spending all your time doing that. But in a mature state of AI, the relationship will be one of where you ask questions, you get back answers. You still have to, and there are other triggers for the AI to give you information. But as the experienced risk manager, your job is to separate the wheat from the chaff, as it were, and do a thorough examination of what it gets back to you, and plan your next steps accordingly. Again, asking the right questions, having the right sort of workflows, agentic workflows in place, which prompt the AI to ask the right questions and come back to you, will be very important. And so those skills, I think, will become more important. I don't see AIs taking over risk management altogether, but I hope so. Being good servants to your design.
So Yaakov, I guess in a similar vein, what kind of barriers do you see to adoption of risk of AI and risk management over the next few years?
Well, look, I think we talked about some of these. I think data still remains to be an enable, but also a barrier. I think Sushant talked about it a bit, but having these tools and kind of desire to apply these tools to internal data forced organizations to make sense of their data, to clean up their data, right? To compartmentalize it properly, so that the tools are obviously picking up signal less and less noise. I think understanding how the models work. I mean, when risk management, we always talk about, well, to be a super user, you need to understand how the models operate, what are the assumptions, methodology. I think it gets harder with AI tools because again, there is a bit of a stochastic, obviously random sort of aspects to what you get out of them, and obviously we talked about the ways to control for that. But I think there's always going to be this concern of sort of getting noise rather than signal from these tools. Both in risk management, but also investment management side. But that said, I think the benefits will outweigh the costs. And similar to Sushant, and I think he did a pretty good job of talking about the future of kind of risk management. But given my kind of what I do and kind of the portfolio managers I work with, kind of to draw parallels, what does it mean for investment sort of industry and kind of how the investment process works? I think in similar vein, if you think about what financial analysts, stock analysts spend their time on, they kind of mostly spend time ingesting data and then digesting data, right, to come up with the recommendations. And I think in 5 years, the process of ingesting data will take less and less time because you can have a modeling agent that kind of updates your kind of discounted cash flow models. You can have your earnings listener agent who that will listen to earnings and digest information. You can have an agent that listens to podcasts, so watches kind of YouTube videos of founders of different companies to see if there's anything kind of useful that can be gleaned from that information. Could be a macro agent, right, industry agent, and then the majority of the time will be sort of taking the input from those kind of or some flags from those agents, right, and making connections between all those data points, which again I think AI for now might be good in some areas, not so good in kind of creating new sort of knowledge, right? Or kind of knowledge it's not kind of baked into the training data set, right?
I think to the point about ingesting data and the connectivity that's going to happen, one of the issues, of course, is the cannibalization of data that is occurring and has occurred, and we've seen lawsuits already about that. So that's a key area that needs to be tackled, and it's nowhere near been understood well enough to have a opinion on. So, any data vendor sends out their data, the licensee takes it and plugs it into the LLM, and it becomes their data. And then not only that, but then the output from the LLMs, you don't know what the data source is. So with this whole ingestion issue, it becomes really important to figure these boundaries out. And this is just starting. This discussion just starting to figure this out. So there's a lot to be done before we get to this, this ideal of being able to have all sorts of data interconnected to each other. It's really fascinating. But from your side, Cindy, what do you see going forward with third-party connectivity and so forth?
Yeah, things are still in silos. Pretty much any company you're going to go to, be it a bank, private equity firm, what have you. And so AI can definitely help with that, connecting internal repositories. So I already mentioned some of this. So right now we have a third-party vendor for our policy management. And then we're also Microsoft Shop. So that means that we use SharePoint and Outlook, and our web pages are based off of Microsoft products and with the background of SharePoint. And what would be really helpful is if all of this stuff can talk together. So for example, I'd already noted that, being able to not only look at the regulations and doing regulatory horizon scanning, you also want to be able to look at your other documents that the firm has, or presentations, or even workflows. So say, for example, a topic is discussed at the risk committee and it's minuted. And then it says we should make sure that we do this going forward. That's a great way of being able to scan that type of information to make sure that the policies and procedures are updated correctly. And often you'll have some sort of business requirement document saying, this is a new process we're starting, this is what our requests are. That type of information can be included in a procedure. So that way you're making sure that there's connectivity, things aren't being left out. And it also, if you have the appropriate audit trail, where all of that information then is coming from to help update or create documents. We also talked about the external regulatory intelligence. So we really want to make sure that information is coming from trusted sources, such as government portals, regulatory bodies. So if there's some sort of scraping or what have you of their sites, that it's coming from those sites and not someplace else. You want to be able to definitely cross-reference those and make sure there's comprehensive coverage. Having that, not only do you want to have that, a lot of firms have what they call GRC tools, governance, risk, and compliance. What tends to happen is that either regulations are put into that tool, or there might be some sort of regulatory horizon scanning for those connections. Then the firms determine what type of obligations they have and what are the associated controls with those obligations. And a lot of those often controls are things such as a procedure. It's more often procedures than policies. It could be training. It could be some sort of stress testing that is done. But you want to make sure that those controls, those obligations, are included in the controls that are in the policies and procedures. So having that interconnectivity is not only with thinking about the regulations, it's also looking at that GRC tool, what kind of obligations you have in there. Do you have the appropriate controls? Are those controls then codified in your procedures? And so that way you have that whole loop, right? And so nothing's being left out.
Thank you. Another thing, specialized LLMs can also be constructed where you can have the data be very focused to help prevent data loss. One of the techniques that's being bandied about now and discussed